Welcome, everybody. Thank you for attending the Origin QOZ II Fund Update webinar. I'm Michael Episcope, co-CEO of Origin, and I'm excited to be here today with David Scherer, the other co-CEO. David and I used to do all the webinars together, and now our team has stepped in to host these as well, so it's rare we are both on together, but great to be with you, Dave. Dave and I have been friends for almost 20 years, close to that, and started Origin around 16 years ago. And people often ask us, how do you guys divide up responsibilities? And this wasn't always the case, but about 6 years ago, when the business became a little bit more bigger and more complex, we decided to split it up in the following ways. So I oversee investor relations, marketing, and operations, and Dave oversees the real estate side, which includes investment management and the acquisition teams. And where we come together is in a couple places. Number one is credit committee. We decide which deals get approved. We each have 1 of 5 votes. We have team members on that committee as well. And the other is in developing company strategy and culture. And it's been an iterative process over the years. We've assembled an amazing team, and we're very proud of what we've built. And we appreciate you taking the time out today to hear more from us and learn about this fund. Our job today is to give you progress to date guidance and answer your questions. Any questions that come up during the webinar that you think of, they can be submitted in the Q&A box, and we'll get to those immediately after the presentation. Dave and I are going to try to keep this to between 30 and 40 minutes, hopefully on the shorter end, but to give you enough information along the way as well, and the whole webinar to under an hour. After the webinar, we do send out a survey. I don't like surveys. Nobody likes surveys, but we do appreciate if you fill those out. They help us improve the webinars, and it's really about you and getting that constructive feedback, and so we can make future webinars even better. So let's jump in. I'm going to start with sort of the basics about the fund. The strategy of this fund is to develop a portfolio of 10 to 14 Class A properties in qualified opportunity zone areas and geographically diversify the portfolio in Sunbelt states. So Dave and I are sitting in Chicago right now. We do not invest in Chicago. I'm sure you can see our maps in the decks, but it's basically the Southeast Texas and the Southwest, and we include Nashville in that kind of Southeast portion as well. The fund's target is a 10 to 12% IRR and a 2.25 to 2.5 net multiple over 10 years. And that's really kind of a pre-tax and a post-tax because of the QOZ benefits and the benefit of getting depreciation during our hold period. We have raised $190 million to date, and we're 65% to our cap of $300 million. Anyone coming into the fund today will acquire units at $10, and this is the same price as when we launched the fund. But the equalizer for early investors versus later investors is the preferred return. So your money begins to earn that 7% preferred return the day it comes into the fund. And we're not going to mark up the fund or mark to market until after it closes, and some of the deals have gotten closer to completion. There was a question that we received earlier from those who emailed us, and it was about this fund not tracking as close to Fund 1. And that's not really the case. We haven't marked this fund to market. We haven't produced any returns. So if you're looking at the projections, we haven't changed our projections in this fund from the day we started. We still believe we're going to achieve that 2.25 to 2.5 net multiple over those 10 years. So nothing has really changed. Certainly the state of the markets is in flux today, and I'll talk about that on the next slide in a second. Don't go there yet, Jeff. 2 QOZ benefits. We still have the tax deferral. So if you invest today, this year, you won't realize your taxes until 2026, pay them in 2027. And then the best benefit of the QOZ program is the tax forgiveness. And so if you're in this fund for 10 years and a day, you will not pay any taxes on any of the gains. We get the question a lot, when are we going to close this fund? We do have a $300 million cap. It's likely we hit that cap in the next 4 months. However, there is legislation floating around that could extend the program and bring back this step up in basis. So this legislation is essentially going to push the program out, the deferral period to 2028. that would retroactively bring back that 15% step up in basis, which would be great for everybody and make the program even better. And if that happens, we think that we're going to hit our cap within 2 to 3 weeks of that legislation passing, and then we'll have to look for QOZ 3 and beyond. The program, it still has bipartisan support, and there's about a 60% chance that this happens sometime in sort of the next 90 days. Let me jump into state of the market. Next slide, thank you. And this is certainly on everybody's mind today. Interest rates, rent growth, inflation. The Fed is absolutely determined to take the punch out of the bowl. Another 75 basis point hike is expected today, this week. May have already happened. We've seen a dramatic rise in long-term and short-term rates over the last 7, 8, 9 months, and there's really nowhere to hide. Higher rates, they hurt us in kind of 2 ways, and they help us in another. The way they hurt us is they increase financing costs, and that's pretty obvious to most. Average loan size is around $50 million. So at 3% rates, which we could have gotten a year ago, our cost to finance would be around $1.5 million per year. And at 4.5%, that same loan costs us around $2.25 million. So you're talking about a 50% increase in financing cost. It's not immaterial, but it's manageable. And there's 2 ways we mitigate this risk and manage this risk. And the first way is that we hedge rates. And around 60% of the debt in this fund is hedged between swaps and swaptions. A swap is something that you enter into at the property level with the bank to lock in long-term rates. And a swaption is something we do at the fund level. It's a contract also with banks like JP Morgan, Goldman Sachs, and it's an asset that essentially grows as interest rates go higher. So that's 2 ways in which we've directly hedged the interest rate risk on this fund. And the second is that just in the strategy itself, we're creating value through the development process and developing to a return on cost, or what you might want to call a future cap rate of 5.5%. And the higher cash flow is the best way to protect against higher expenses. The second way that higher rates impact us, not from a valuation perspective, but it's really about refinancing, is higher cost. That means we will have less proceeds when we refinance. And that's a huge source of our future cash flow. So today, as we've seen rates go up, banks have pulled back. We're now seeing banks in that sort of more 55 to 60% loan to value than the 65% and even 70% that we saw a year ago. And loans are sized based on both loan to value and a debt service coverage ratio. So the higher the debt cost, the lower the proceeds. The way higher rates help us is on the demand side. And I've said this before on other webinars, but there's more than 20 million Americans who can no longer qualify for a $400,000 mortgage. So as rates go up, they're not just hurting on the multifamily side, they're also hurting on the for sale side. So you can imagine a year ago when mortgage rates were under 3%, now they're above 6% today. Home ownership has become far less affordable than it was. And the same thing we've seen on the inflation side with costs going up 20, 30, 40% over the last couple of years. That relationship holds true on the single family side as well. So it actually helps us on the demand side considerably, because many of these individuals who are would-be buyers, they're now forced to rent longer than they would. And you've got a demographic coming in behind them who's also creating demand for apartments as well. So we're seeing rents still climb at sort of those high single to almost double-digit rising rents this year. And rising rents, they can really offset the impact of higher financing costs and higher cap rates. The last thing I'll touch on here is inflation, and it really does look like the worst is behind us. Material prices have come down significantly, and it looks like we're going to be settling into more of a normalized inflation rate on the construction cost side of around 3 to 5% per year. We don't expect prices to come down significantly in the near-term future for construction. The biggest issue in that is the shortage of labor, and labor does not like to give back gains, and they traditionally haven't. So we might see some better pricing here than what we initially anticipated. But the reality is that once you have inflation in the market, it tends to be sticky and stay there. And there's really only one time in the history of the United States that we've seen inflation gains given back, and that was after the 2008 financial crisis, or at least construction costs moved down significantly over a period of time, and that was only by about 10%. So the state of the market, to say the least, is in flux. And what I'm giving you is a snapshot of where we sit today with the information we have available. And in 12 months, we could easily see the 10-year back down to 2% if we go into a recession. The most important thing to keep in mind is that this is a 10-year hold for many of us, and information changes. And for somebody like myself and Dave, who are going to be in this program for much longer than 10 years, it's likely that we're going to go through multiple recessions, slow growth period, high growth periods. And the next slide is really where the positive news comes up, especially for us long-term holders. And this is the really positive news, is that the long-term outlook is very favorable. This chart was created by our predictive analytics model. We call it Origin Multilytics. It incorporates billions of pieces of data to arrive at rental growth rates, future rental growth rates, and really looks at the supply and demand of all kinds of things that you can imagine. 2022 has seen high single-digit rent growth across the board, but a lot of that is going to be given back in 2023. We, like others, believe that there's going to be a slowdown. Whether that translates into a recession, we don't know, but clearly interest rates are having an impact. In 2024, we began our upward trend again. And the most important line to look at here is the bottom one, where you get to see the average rent growth over 5 years. It's incredibly strong. It's above the long-term average of kind of 2 to 4%. And what I'll say today is that rents will be higher in 5 years than where they are today. The Fed can influence the flow of money, but what they can't influence is demographics. And there's still a housing shortage today, and it's going to be there in 2 years. So this is, when you think about investing, the best years of the stock market happen after downturns, and real estate is no different. So we're always mindful about what the future holds, looking at the horizon in front of us, looking at downturns, protecting money, finding ways to underwrite more conservatively. But we're very optimistic about the next 10 years, especially in the markets we're in and the asset class we're in as well. The next slide is the last slide I'm going to cover before I hand it over to Dave. And this is really about the cash flow. So we get a lot of questions about this. How much cash am I going to get? And we've updated this slide. So this looks different than the last time we had this webinar. And this is really a range of possible outcomes of cash flow that you can expect in 2026 and 2027. And as we sit here today, we will be able to return between 10% and 20% of your invested capital by the time your taxes are due. After that, the portfolio will generate an annual yield of around 5% on invested equity. Now, we're still 3 to 4 years out from this happening, and we all know that this forecast will change several times over the next few years. The purpose of showing you this is to paint a realistic picture so you can plan accordingly and we can set realistic expectations. As properties get closer and closer being delivered, this forecast will become more accurate. You have a greater dispersion the further out you are. It could be that we actually return 30% and the yield is 10% and not 5%. A lot of this is going to hinge on where rates and rents are at that time in the future. And as my favorite baseball player once said, predictions are hard, especially about the future. So thank you. Dave?
Thanks so much, Michael, and good morning, everyone. I want to make sure that everyone understands we want it to be interactive. Please ask your questions in the Q&A box. We only have a few so far. Usually we have dozens. So please, I know you have questions. A few dozen were sent in prior, so we can cover those if we don't get the live ones, but we give priority to the live ones. So as Michael talked about earlier, my responsibility at Origin is analysis, acquisitions, and investment management. And one of the reasons we're a top 3% real estate manager globally since 2015 across numerous funds is our local presence in all of our markets. So Michael was talking about how we cover the Southeast and the Southwest and Texas, and my job is definitely one with a lot of travel and interface with teams that live in their markets. So we're very much spread out. We think that that's a powerful combination when you have a local presence, but also centralized analysis and machine learning AI in Chicago. And that's how we're set up. So development experience, I'm going to take you through our realized deals first. 435 million of realized deals. They've equated to a 25.7% gross IRR and a 2.03 gross multiple. We're very proud of that. We get this question a lot. Michael talked earlier about QOZ, our expected net returns, that's after fees and promote, 10 to 12% in this fund. We already got a question on that, so I'll just address it. If you're thinking about a QOZ fund, it's actually two different strategies in one fund, and you need to have a manager that you trust to do both. So the strategy first is development. You have to improve it by as much as you pay for the land. So if you buy land for $30 million, you have to do $30 million of improvements to comply and get the tax benefit. And then, of course, you have to hold it for 10 years. So there's a construction period. And in that period, we're looking for 15 to low 20s IRRs, as we do in all of our deals. Once stabilized, meaning it's built and it's occupied and there's rents that are being collected, then it shifts into a core strategy where your manager has to operate, maximize net operating income, risk manage. And so you need a manager who can do both. We believe we've proven to do both, but as an investor, now your expected return looks more like 8 to 10% from years 5, 6, 7, 8, 9, 10. So that's one reason the IRR would be lower, because you're getting both a core asset in the later years and a development in the early years. The other reason is just math. It's a 10-year hold, and IRRs come down over time. It's just the math of IRR, but multiples go up. And the multiple on this fund, Michael mentioned, was a target 2.25 to 2.5, 2.6, 2.7. It's very difficult to model that far out. We tend to overperform. I'll just say that. And over a 10-year period, we're pretty confident in the wealth we'll create. And of course, it's extraordinarily tax efficient. And that's why Michael and I are so heavily investing in both QOZ 1 and 2. Next slide, please. So transitioning to the amount of development that is in process. And so when I say in process, we have 44 deals, 3.7 billion of development currently in process. Some of these deals are in lease up, meaning they're completely built, and we're in that phase. Others are in construction. Others are in planning, pre-development for construction. And one of the huge advantages this fund has, QOZ 2, is it's actually the 5th of 6 funds that we've done with development. It started in our Growth Fund 2, then our Growth Fund 3. Income Plus has development exposure. We do build to core there. Growth Fund 4, and of course QOZ 1. And so what I'm conveying here is because we're so hyper focused on our markets and because we're so active in development, it really leads to a tremendous amount of deal flow and a tremendous amount of experience on our team. And we continue to hire experts in construction and development to execute and hone our craft on a daily basis. So you're benefiting in this fund from extraordinary amount of experience, but also a focus on one asset class, multifamily, really 12 cities in these 3 regions, and local presence. So we're pretty confident that we will overperform our competition. No one knows what, I love your quote, Michael, no one knows what the future holds, but I'm very certain we'll outperform our competition. Next slide. So how do we outperform? Michael mentioned interest rate mitigation. I would only add, when you're talking about QOZ 2, because that's what this webinar is about, Michael mentioned that 60% of our developments, and we'll get to that in a moment, are hedged. 85 to 90% of this fund has already been sourced, and I'll get to that in a moment. So one of the things that we want to do is hedge the interest rate risk of developments that are in pre-development. And you can't do a swap on a development where you haven't actually set up the loan. The loan is the asset the bank wants to swap with you. And so in that case, we're going to the fund level and using swaptions. The combination of swaps and swaptions has produced a 60% hedge to this fund. I don't know what our competitors are doing, but I'm relatively certain it's not as comprehensive what we're doing. And the reason, and by the way, that equates to, at this point, $8 million of profits that directly flow to this fund. And that's a combination of the first set of swaptions we did in January, which we actually sold and realized a profit, and the profits on the second set of swaptions that were done about 6 weeks ago. So there's $8 million of capital that's available to pay for higher interest rates in this fund alone. And if you're in any of our other funds, we'll be sharing all of this with you from our investor relations and on these webinars. But it applies to Income Plus. It has its own P&L with its hedging strategy. It applies to QOZ, et cetera. So this is no different. So why do we hedge interest rates? The simple answer is because we believe we're building to a very high margin. I'll talk it just, I just want to dumb it down a little bit. We build for about 300,000 a unit. Obviously it's a range and it's a function of the region and the product type. Garden is cheaper than Podium. Building in Denver is more expensive than building in the Southeast. But that said, for an example, just to illustrate, let's assume 300,000. We tend to sell when stabilized for between 410 to 450,000. That's the profit margin. And because we have experience in doing this and a track record, we feel that it's both profit margin and risk mitigation. So if there is a correction, you're actually not losing capital, you're losing profit margin. And we like that element of it. It's also why we hedge interest rates, because we can't control where interest rates go, but we can control elements of development that we think we're very good at. So we want to try to hedge away the things that we can't control. And then protect and grow, that's the philosophy of Origin. And it starts with the fact that Michael and I formed the company to protect and grow our own capital. Michael and I remain our largest investors in aggregate, $75 million of our own equity in our funds and significant equity in this fund in QOZ. This is where we want to protect and grow our money and of course, your hard-earned money as well. Next slide. I mentioned earlier that 85 to 90% of this fund is sourced. A lot of these deals are starting. Some are in construction, some are in pre-development. What you're looking at here, and I'll go into deeper detail on a few of these deals. I don't have time to go through all of them. But if you have questions about any deal I don't cover, David at origininvestments.com. I'm happy to either answer it or defer it to the acquisition officer in that region. And they can do that, or the investment management team in that region. But the big picture here is, as Michael mentioned, all of these deals, there's been a tremendous amount of movement in the variables affecting development, but they've counterbalanced each other. And we're confident that even with the higher interest rate environment, because rents are higher, significantly higher. And by the way, how much higher are rents? Over 20% of CPI, when you read it every month, is the cost of housing. And the cost of housing is measured as rents. That's how CPI measures it. In other words, CPI can't really go up unless rents are going up. And that's exactly what's happening. And so multifamily real estate has really become a non-correlative asset. It doesn't correlate with the stock and bond market. And it's performed quite well this year. That doesn't mean it'll always outperform the stock market. It just means you as an investor want to have assets in your portfolio that don't correlate. Some years multifamily will outperform, some years it won't. But right now, most portfolios are all moving in the same direction, and that's bad. You actually want to have a portfolio that mitigates risk. And I would argue that in the last 12 to 18 months, hard assets in demand like multifamily have proven to do that. The fund is 85% sourced, 256 million. Just doing the math, it's a $300 million target. Candidly, right now, we have more deals in capital. And the reason we do is we've only raised 190 million. Number one, it takes a long time to go through pre-development, and the costs are escalating over time. So we're pretty sophisticated about our cash management side, and we're confident that we'll raise the money as well. So what we don't want to do is raise all the money and then go try to find the deals, because that creates drag for you as an investor. In other words, you're going to wait a year and a half for us to find the deals, go through pre-development, invest the money. And so that's what we're constantly doing at Origin. This is no different. Growth Fund IV is the same, is we're trying to balance raising capital with putting it out quickly so that you don't have what's called a J curve, meaning you're not investing your money so it's sitting idle, which you don't want. So I'm going to go a little bit into more detail on a few of these deals. Next slide, please. So the first is Solis at Ballpark. And this was sourced by Tom Briney, who runs our Western operations. Tom has been with us a little bit over 11 years. He came over from Blackstone in 2011. I would argue he's one of the best acquisition officers in the country and what he does. Solis at Ballpark is a 296 unit multifamily development, of course, within an opportunity zone. It's in Goodyear, Arizona, which is one of the fastest submarkets of Phoenix, and Phoenix is one of the fastest growing cities in the country. Importantly, the rent growth has been phenomenal over the last 5 years. And so this is a market that not only has very strong rent growth, but Arizona itself has very friendly tax laws relative to real estate, which keep taxes low and our NOIs quite high and our cash flows high relative to other states that have much higher real estate taxes that reset much more frequently. Here, they don't reset as frequently, and so they stay much, much lower longer, which is great for a long-term investment. The site is located adjacent to the practice facilities for both the Cleveland Indians and the Cincinnati Reds. We get a lot of questions about timing. We're very far along in pre-development here. Groundbreaking is Q1 2023, so that'll be here quite soon. Construction completion, we are estimating at Q3 2025, and stabilization Q2 2026. So stabilization, Michael did this in aggregate, but that's implying that that's when cash flow is going to hit the fund level. In terms of our machine learning and AI, again, Michael was handling it at the macro level by the city. The reality is our machine learning does it all the way down to the address level. It's our belief that we have the best machine learning technology in the industry. We built it because we felt everything you could license is inferior and not solving your problems. We've done webinars on that. We should probably do another because we just got the new data. We have 2 full-time data scientists, and they presented a 122-page report that we went through last week. The AI on this site for 5 years is 4.25%. Again, Michael mentioned historical average is about 2 to 3% rent growth. So we're well above that. And importantly, the model that's producing the returns that we're then rolling up into our aggregate returns, we never use rent growth at 4.25%. We just won't do it. So the model would be significantly lower, meaning if we achieve 4.25 over this 5-year horizon, your NOI will be significantly higher than what we modeled. I'm going to move on to Lofts at Eastland. So Lofts at Eastland was sourced by Dave Welk. Dave Welk, managing director, runs our Charlotte office and some of our southeastern markets, Atlanta, Charlotte, Raleigh. Dave came over in 2011 from Deutsche Bank Reef. I would say he's one of the best acquisition officers in the country as well. And I don't say that lightly. Tom and Dave are among the best, most talented people I've worked with. It's also indicative of the level of talent and consistency we have at Origin. They've both been here 11 years, but I could speak about Mark Turner, who's been here 8 years, or Michael McVicker, who's been here 7 years. Even our regional acquisition officers, Kyle Verhassel, he runs Nashville. He's been here over 7 years. That's why we're a top performing manager. At the end of the day, it's the team, and the team has remained here. And I'm mentioning this because this is a really important decision, and it's a long-term decision. So you should be underwriting the team and the consistency of the team. Is it the same team that produced the results? Because if it isn't, you need to spend time on who that new team is. Is it the same size fund? Because if it's much, much larger, that would imply a different strategy. QOZ Fund II is the same size as QOZ 1. We're doing the same thing with the same teams in the same markets. I mean, these are the types of questions that you should make sure all of your managers can answer. Lofts at Eastland, sourced by Dave Welk, in partnership with Crosland. This is our second deal with Crosland. QOZ 1 did a deal with Crosland in Orlando that's doing quite well. This is a 269-unit multifamily, and it represents phase 1 of a master development of an old mall called the Eastland Mall. What's important about that is the city, because they want the redevelopment of this mall, is offering very attractive land purchase rights to us. We're paying $2,300 a unit, and they're providing $7.5 million of reimbursements via what's called a TIG, TIG, and in Chicago it's called a TIF, tax increment financing. In Charlotte it's TIG, and you're going to see this a lot at Origin. I'm going to mention this in the next deal too. We look for growing cities, interesting sites, good AI, but we also, obviously it has to comply with the QOZ component of the maps, but then we're also looking for cities that want to further incentivize. So we're layering the QOZ federal tax incentive with local incentives because they want development of this site, or in the case of Colorado Springs, which I'll get to next, they wanted new housing stock because there's so much demand for housing stock in Colorado Springs. And that produces more margin, and obviously you're not paying taxes on the margin. That's the QOZ element. $2,300 a unit for this type of construction. Usually you're paying anywhere from $25,000 to $35,000 a unit. So just simple math. We'll take the midpoint. That's 30,000. You can multiply that by 270. You get to a $5 million number. That's interesting, right? It's interesting that we can get into the land at a much, much lower basis. The city officially hosted a ribbon cutting in the last few weeks, and so we're ready to move on here into construction. Project designs will be completed at the end of Q4. And construction will be most likely in January or early Q1 of 2023. Here, our AI, 3.5%. Again, that's at the asset level, not the market level. This is what our machine learning believes 5-year rent growth will be here. Again, significantly higher than what we've underwritten, and is rolled up into the represented 10 to 12% IRRs that Michael mentioned. So the last deal I want to talk about is Elon Rio Grande. And before I talk about Elon Rio Grande, the reason we're doing 3 deals, and it relates directly back to what Michael was speaking to, please give us your feedback. The feedback we received this week was a lot of the investors wanted to hear a deeper dive into individual deals rather than roll up. And so this is in response to that. So if you have feedback, give it to us. We're constantly trying to improve this and give you the experience you want. So Elon Rio Grande is actually the third of 4 deals that we've done in Colorado Springs. We're actually looking at a 5th right now as well. And so before I talk about the idiosyncratic deal, let's talk a little about Colorado Springs. So Colorado Springs, about 45 minutes from Denver. Denver has been growing so rapidly that both in size, but also rents, a lot of middle class to even upper middle class have been priced out, and they started coming to Colorado Springs. It's the same distance from the mountains. It's roughly the same distance from DIA Airport. And so we started to really take a hard look, and AI was predicting very strong rent growth about 3 years ago. And we were proven very right. This has been one of the strongest rent growth markets in the country. It's also one of the strongest rent growth markets going forward in our AI. It doesn't seem to be abating at all. And when we got there, what we noticed was there was very little housing stock downtown, rental housing stock, in a rapidly growing city. And the housing stock that was there was all 80s built. There was maybe 1 or 2 newer projects, but almost all of it was, not able to really serve the needs of what people wanted. And so the city also realized that. And so when we started our first deal there, they were offering 15-year tax reductions of 75%, 70 to 75%. So if you think about that, to get a 70% reduction in your taxes for 15 years, real estate taxes are our largest component of expense in a project. And so it's pretty remarkable what it does for cash flows and returns. And so we saw a fast growing market with huge demand, also in a QOZ zone. Most of the downtown of Colorado Springs is in the QOZ mapping. And then the city, of course, was offering these incentives. So we started our first deal in co-development with Greystar. It's worked extraordinarily well for Fund 1. Then we did a second deal. This would be our third deal. We're also doing a fourth deal with a different partner, Madison Dearborn in the suburbs that we're really excited about. And we're looking at a fifth deal with Greystar currently, who's a terrific development partner, and we think the world of those teams. So Elon Rio Grande, 207 unit Class A development. In terms of Colorado Springs, you have 5 military installations. You have the Olympic City, where more than 10,000 athletes train year round. There's just tremendous employment, wage, and importantly for us, rent growth in Colorado Springs. When you overlay the tax incentives and QOZ, this is how we overperform. And we outperform through selection, but also execution. And importantly, with the mind always towards tax minimization. So in QOZ, it's very easy, and Michael's gone through this, but in all of our funds, we have 3,100 taxed investors. Michael and I are taxed. We pay taxes. So everything we do at Origin is about maximizing returns, minimizing risk, and then minimizing taxes. It's all part of the discussions we have. Luckily, real estate is an amazing asset class to do those things. Here, back to interest rates and mitigation. Here we actually executed a swap because we have a loan. Again, you can make a swap when you have a loan. Our index rate was 2.81%. What that means is that's where the 10-year note yield was when the swap was executed. Today, I haven't checked, but it was around 3.55 this morning. I don't know where it is now. Obviously, the Fed, is making their decision, so there could be some fluctuation. But we have an amazing hedge here on this asset that's already in place. So I believe that's my last slide. Is that my last slide? Yes. So we're going to jump into Q&A, and Michael, the The audience listened. Now we have 19 questions that are live. So why don't you take the first?
Well, a couple here. Larry gave you a nice compliment. He said your sound quality is much better. Thank you for fixing it. Thanks for that compliment. And then Phil gave a compliment on the new portal, saying it is excellent in all capital letters. So Phil, thank you for that as well. That's going to mean a lot to our team. Kate Kazan really ran that whole process of selecting the company, getting it updated. I can't even tell you what a lift that was. Excuse me, for how many hundreds of thousands of lines there were to just get accurate, so that all your data is accurate in the portfolio. And I do want to just tell a story, because my son this last year, he took a gap year, and my wife and I just moved him down to Florida. So this has to do with what's going on with the rental inflation side. And we got him a studio, and I was just shocked by the price inflation down there. And I shouldn't, because I'm in the business, but when you're actually on the other side as a consumer, you're just scratching your head. We got him a studio in the Palm Beach area. It's not on the water. It's nice. $2,300. And I asked the individual who was renting the place to us. He was the property manager there. And I said, well, how much rent increases have you seen this year? And he said, yeah, we're expecting about 10% this year. And then my follow-up question was, well, what did this rent for a year ago? And he said about $1,600 to $1,700. So it's just, I mean, what's happening because of these demographic shifts, the work from home, it's here to stay. People from Boston and New York moving to Florida, just increasing these rates. And this is happening all over this country. The tough part is for people who actually live in Florida. And clearly we're seeing all this inflation happen. And so wage inflation is happening, because obviously they're going back to their bosses and asking for rents or raises to cover like these increases in rents. But it's pretty insane out there when you look at it. So, and it doesn't look like it's slowing down. All right, first question. We got a lot of questions here, different things, different themes. I am going to answer the question, when is the likely first distribution, 2025? So a couple of things here. Number one, we cannot distribute any capital until 2 years after the 24-month anniversary of when we allow the last investor to come in. So that actually would correlate with about 2025, assuming we bring in the last investor this year or Q1 of next year. So 2023 and 2024 would be locked out. That is an IRS rule. It is considered a disguised sale if we do that within 2 years, and we don't want to do that. So likely, but candidly, it's probably going to be longer than that, because the properties take about 24 to 36 months to stabilize, to refinance. And so when we look at the portfolio and sort of where it's shaping up, I would say that you can expect distributions, your first one, in probably second to third quarter, 2025.
All right, I'm going to answer Phil's question. Thanks, Phil, for your question. He has a question about Edge Hill Commons and the rendering. So Phil, I can give you lots of updates. There's only so much time, but this is what I asked for. So, please, any questions, or David at Origin Investments, we can do it offline. But Edge Hill Commons is probably the most interesting site that I've ever seen in my career. It happens to sit in a QOZ, which is amazing. But Nashville, remember the QOZ, when they mapped QOZ law, it was a 2017 law, they used the 2010 census. And Nashville literally had no housing stock in 2010. That's how much downtown, that's how much the city's changed. I mean, Michael and I were there, and 2012, 14, 16. I mean, we've seen this evolve. And so the Gulch, which is now one of the hottest areas in the country, at the time complied with QZ law. So Edge Hill is the former Beeman auto site that sits in the Gulch, right on the highway, great access both ways on and off the highway. But to answer your question, it's an interesting site that requires a tremendous amount of pre-development and thought, because we have 720 units of multifamily density approved. That's a good thing, but you've got to configure it correctly on the site and then overlay the highest quality product you can build, because this is a generational opportunity to build something of high demand for 100 years, right? This is Manhattan, okay? But you also want to minimize construction costs. So we've spent a lot of time talking about, do you do podium? Do you do concrete? Do you do stick over podium? Can you make stick over podium interesting enough to get the appropriate rents you have? Because there's enormous spreads between concrete and lumber right now. And so, these are the types of things that we spend our time on. And I always wonder how deep to take people into the weeds, because the weeds are deep. But the renderings you're seeing are evolving. And so I wouldn't spend a lot of time on what it looks like because it's still fluid. But thank you for the question.
Do you expect that the legislation in Congress will be retroactive to investments made prior to its passing? Yes. And where we get our information from, because there's another question about this, is from Ashley Tyson. He's somebody who I would consider the guru in this area. He has his finger on the pulse of the market. He's a tax expert. He keeps in touch with what's going on in Congress as well. Sits on a lot of different committees. And the reason why is because what they're talking about doing is extending the program out by 2 years. So the deferral wouldn't end in 2026, it would be 2028. And the way the law is written is your step up in basis is determined based on how many years from the end of the deferral period your investment is made. So it ended in 2021, so you got a 10% step up in basis because the program ended in 2026. But if it ends in 2028, then that step up in basis will come back for 2022 and 2023 and will be retroactive for investments that have already been made. So we're pretty excited about this, keeping an eye on it. It's a great program without that, but clearly if they can bring back the step up in basis, it's better for everybody.
Mike, thanks for your question about Michael and I's co-investment in Fund One, QOZ Fund One and QOZ Fund Two. We really want to be transparent, but there is a limit to what I want to share. So we have done 75 million in aggregate across our funds. I will tell you that his question was how much specifically we invested in Fund One and Fund Two. We're among the larger investors in both funds, but I'm not comfortable, giving that exact amount, and I hope that you respect that. Thanks.
Yeah, next question. Can this be used in place of a 1031 exchange to preserve capital? Yes, it can. In some ways, the QOZ program is better than 1031, and in some ways, the 1031 actually, has advantages as well. So the advantage of investing in a QOZ is that you only have to invest the capital gains. You do not have to invest the principal, and you can invest some, all, any percentage that you want. Whereas in a 1031 exchange, you have to invest both the principal and the gain that you have in there. So that's one of the advantages. The disadvantages is that eventually you have to pay the piper in a QOZ fund, that you will pay those taxes in 2026. Hopefully that's, now, going out to 2028. But certainly if you can't find a replacement property and you're not comfortable with the 1031 exchange market, and we've done a lot of research on this market, and I certainly know people who have done that. You have to be careful about letting the tail wag the dog here. And that market tends to be really ripe with high fees, and sometimes the tax savings or the fees can offset the tax savings itself. So definitely something you and anybody who has a 1031 exchange should consider is going into a QOZ fund and maybe taking some of those chips off the table as well.
So we have two questions about partnering in developments, one from Ben and one from Arul. I'll answer both. Ben asked, do you always partner with a sponsor? Arul asked, what role does Origin play when we're doing a joint venture? And so a couple things. One, no, we don't always partner. Some of our deals we develop directly. For example, Sawtell is a deal where Origin is the developer, but there's other deals where we're the co-developer. There's other deals where the LP and we bring in a developer. So it's deal specific. We do all these things. And then, Arul, to answer your question, because we're so active in both direct development, co-development, or being the LP, we have both the team experience and scope to be incredibly involved in every aspect of development, whether we're developing it direct or joint venturing. And our partners understand that we're going to be very involved in all the aspects. And we like to believe that we bring a lot of experience and add value. We have 3,700 units in development. That right now, there's not a lot of firms that can say that, meaning we see a lot, both from the design standpoint, construction standpoint, all elements. We're getting data from multiple deals all the time. So I hope that answers your question. The last thing I would say is increasingly we're trying to do more development direct, and we have a goal of making that significant going forward. And the reason for that is direct development yields higher expected values on deals for the fund. So the more that we can do, the better. But of course, there's a flip side to that, which is we need to actually invest money for you. And to do that, to get diversification across 10 to 14 deals, geographic regions, et cetera, it's important to be able to do both. And I think we toe that line really well.
What is the penalty for early withdrawal? We got this question from a couple people. There is the ability to withdraw earlier. There's a penalty that's associated with it. It starts at 10% in year one and then declines 1% per year. When people come into this fund, we want them to really be committed to a 10-year hold, but we also understand that life changes. And so if that happens and you need the money for some reason, there is the ability to redeem as long as we have the capital available to do that in that situation. So it's hopefully that answers your question.
This is anonymous. Can you give an example of what is in the model for rent growth if AI machine learning is projecting 4.2? Yeah, let me just take you through a little bit of how we model. I mean, number one, we don't trend rents during construction. And then typically we're using anywhere from 2.5% to 3%. I mean, that I'm generalizing, but if you look at the life of a model, if it's 5 years, it winds up averaging about 2% because it's zero for the years we're building, and then it's 2.5% to 3%. So that's another way of saying if AI is correct, our NOI should be quite a bit better than what we're modeling.
This is just a clarification question. Somebody asked about what is the step up in basis. So I'll answer that. So the step up in basis is simply this, that when the QOZ law was enacted, there were 3 benefits. You had the forgiveness, you had the deferral, and you had a step up in basis. And what that means is that if you have $100,000 and you've realized $100,000 in capital gains and you invest that into a QOZ fund and the step up in basis was 15%, what it means is that you'll only recognize 85% or $85,000 of that capital gain in the future. And what that does is it helps to mitigate against higher tax rates in the future. So instead of realizing or recognizing $100,000, you're only recognizing $85,000. So if capital gains rates go up to 30%, you're essentially paying the same taxes. So that's the step up in basis.
This is anonymous. You mentioned that you unwound your first round of swaptions and realized the profits. At what interest rate level would you unwind the current round of swaptions that are in the money today? There wasn't a rate last time, and there's not a rate now. The reason that we unwound the first set was because we were executing swaps and putting long-term debt on assets as they were stabilized. So in other words, you can sell the swaption as you're hedging it a different way that might be even better. But we can't do swaps until we have the loans, and we can't refinance into long-term fixed debt until the property has cash flow and is stabilized. So That's no different now. We have swaptions, and they will be replaced with swaps or long-term debt. This is not a trading strategy. There isn't a level that we would say, oh, well, now we just want to take the profit. It's a hedge. But thanks for your question.
So I'm going to try to, how do you deal with the premium that you guys get pertaining to taxes? And I think this has to do with maybe underwriting, but if you can restate the question, if I don't answer it correctly, but I'm going to answer it this way. We don't look at QOZ developments any differently than we do market rate developments. We don't have a different model. We don't look at things. It has to pass the same criteria as Growth Fund IV. So there's nothing different. If we were to show you the after-tax equivalent return, and we do that in our deck, it's about 60% to 70% more profit that you would need to achieve on a taxable investment to get the same sort of returns here. So if we're looking at the after-tax equivalent multiple, instead of 2.25 to 2.5, you have to achieve approximately a 3x multiple over 10 years to get the same kind of wealth creation. I hope that answers your question. I was trying to interpret it. Thank you.
We had a question sent in prior. Is this program a substitute for 1031? I'll answer it two ways. Yes, it is a substitute if it's real estate related capital gains. So 1031s are a deferral of taxes. This is an elimination of taxes. I would say it's better from that standpoint. But you also have to hold it 10 years. The 1031 you don't. So you know, there's differences, but I would say apples to apples. If you want to hold something 10 years, this is better because you're eliminating, you're not just deferring. But the important thing is 1031 exchange tax deferrals only apply to real estate capital gains. And this applies to any capital gain, right? So you sell a piece of art, you sell your home, you sell your business, you sell stock. And this is what's so different about qualified opportunity zone investing is it's opened up the whole world and all capital gains. And by the way, short-term or long-term capital gains. So it's a very different animal. But if you have a real estate capital gain, I would still tell you it's a substitute good. And if you're willing to hold longer, it's better.
Couple of questions here. This is, Dave, I think you answered this, but I'm going to just, do you have to invest principal and cap gains or just cap gains only? It's just cap gains. You don't get the benefits for principal. And then the other question, does any of your growth fund also invest in QOZ fund? No, it doesn't. The way we decide if we have a QOZ ground up development or ground up development in a QOZ zone, it goes into the QOZ fund. If it's market rate outside, it goes into the growth fund. So it's very black and white to run those funds side by side.
All right, I'm going to answer one more and then we got to sign off because I know Michael and I have other things at 11. So we gotta jump. Question about cap rates. So if rates stay higher and cap rates go higher, you know, what do you see and what's the risk? The way that we mitigate that risk, and we've been doing this for the last 10 years, is we drift our capitalization rate 2% higher per year in a model. We don't know where cap rates are going. No one does on this call. We can make all kinds of speculations, but in our models, we're taking them up 10% over the 5-year development period. And it still has to meet our cost of capital, which is essentially a 2x multiple over 5. So there's an awful lot of conservatism built into our models, both at the deal level and in aggregate. Michael mentioned construction costs. We have enormous contingencies in our models for construction costs, much higher than the growth rate of construction right now. We're drifting our cap rates higher, but none of us know if they're going higher, but our models account for that. And so these are the types of things. These are great questions, but we don't know the future. I just know that I like the expected value of how we model and what then ensues.
Thanks. Thank you, everybody, for joining us today. And I would say there are a lot of questions we didn't get to. We just don't have time today. and they are important, we will try to reach out to you individually and get those answers, somebody on our team. And if you need more information about the fund, go to our website. And if you're a new investor, you can download the deck right there. You just have to sign up. You can download the information. And if you're considering an investment, then the next steps would be to do your due diligence. There's more materials online. You can set up a call with somebody in the investor relations department. They will take care of you and help answer any of your questions. David already gave you his email address. It's david@origininvestments.com. Mine is similar, michael@origininvestments.com. So it doesn't get easier than those two. And email us if you have any feedback, if you have any other questions. We will either answer it ourselves or get you to the right place. We really pride ourselves on having that direct connection with our investment partners. Obviously, that's been more difficult the bigger we've gotten, and we have 3,200 investment partners today. And these webinars are really a way for us to connect with you and talk to you directly at sort of scale. So thank you very much. Really appreciate your time today.